Everything seems to be going up, up, up. So we're going to dive into some macroeconomic indicators during this episode, and then certainly bring it back down to what does it mean for the market. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. Up, up, up. I'm going to talk about three economic indicators that I think will have an impact on the overall market. So the first is the price of crude oil per barrel, right? So right now we're at $86 a barrel, and it seems to be climbing, right? So RSI's kind of popped up positive, MACD's crossed over and popped up positive, and the price actually came down to the 200-day moving average and found some support and has risen back through the 20 and 50-day moving averages and seems to be heading north. So what does that mean to the consumer? Well, the more we spend on gasoline, the less we have to spend on everything else, right? It just makes sense. In fact, if you look at 2022, when the price of oil just climbed and climbed and climbed and peaked out at over 121, almost $122 a barrel, you saw the stock market getting pummeled, and then it started to drop down, and the stock market started to correct. So here we are. The price of barrel is breaking out again to the upside. So we want to just pay real close attention to that in relation to the price of stocks. All right. The second indicator is the prime rate. We're at 8.5%. We haven't been at 8.5% in over 20 years. So it was April 2001 was the last time that we were at 8.5%. So what does that mean? Well, the prime impacts all of our lending, right? So mortgage rates, auto loans, small business loans, pretty much anything you want to take a loan out for is going to be tied to prime. And so at 8.5%, essentially the government is starting to slow down the economy by raising rates. So as rates rise, prime rates rise, and so lending rates rise. And so the more we spend on interest, the less we have to spend on consumer items and nice to haves, right? So now we're spending it on must haves like gasoline and, mortgages. And so we want to watch the prime rate and just make sure it doesn't get out of control. All right. So the last up here is the dollar. So the dollar and the stock market are not reversely correlated, but there is some rhyme and reason to it. So I put a couple of perpendicular lines here that I think just draws your attention to the difference, right? So when the dollar tends to peak out, you see a kind of a bottoming in the S&P, and then when you start to see basically a topping in the S&P, you see the dollar really starting to catch wind, and then vice versa. So now you're starting to see the dollar rise, and so we just want to watch this. It's not, it's definitely broken out to the upside, and you're starting to see the S&P wobble a little bit. So we just want to keep a real close eye on that and make sure that the dollar doesn't get out of control, because obviously it's not very good for the stock market. All right, so what does a rising barrel of oil, a rising, a high prime rate and a high dollar due to the stock market? Well, time will tell, right? But historically speaking, it's not great. So we want to just make sure that we're watching those indicators as well as other macroeconomic indicators, and then obviously keep a real close watch on our levels on the S&P. So I was putting this together last night and started almost kind of thinking about it in terms of like a rhythm or a musical flow, and started looking at the lines and almost thinking about them as being staff or stav, whatever they call it in music, where you've got these lines essentially, and then the stock price almost looks like musical notes. So there's this rhyme and this rhythm that kind of happens within the stock market, kind of similar to music. And so we've got this, they call them staffs. These lines essentially are our playground. And until the story changes, that's what we have to assume is going to continue to be our playground until the story changes. So does it break up and out, or does it break down and out? And so we want to obviously change the musical sheet when that happens. But until then, we have to kind of play in this playground. And so right now we've got some overhead resistance between this line and then we've got this black kind of line coming down. So if you look at the last time this black line kind of came down, I mean, obviously it had a little bit of trouble getting through it. and came all the way down to this bottom line before it could break through and continue its move upward. And so, we just want to watch this and make sure that these various levels, these green arrows that I've put here, hold, right? So we've got the 20 and 50-day moving average. We've got this staff, and then we've got this bottom staff line. So we want to make sure that those hold. So obviously, if it breaks down, then it could be a sideways trend, or it could be a downtrend. If it breaks up, then it could be, heading, for all-time highs. And so that's really what we want to watch. But obviously, the macroeconomics do not support a breakout in all-time highs of the S&P 500 at this point. And I think it's going to be a little bit crazy to think that we could avoid a recession when we've got such terrible macroeconomic kind of things going on. Right now, the consumer's holding us up, but how much longer can they? So we need to watch these and really make good choices. So as a quick summary, I think you can see that the economic indicators that we watch certainly can and will probably have an impact on the market, in the near to short term. So we're watching all of that, and we'll certainly keep you abreast. But if you have any questions, give me a shout, and I'll see you on the next Markets in 5.